A moving average is a technical analysis indicator that helps smooth out price data by creating a constantly updated average price. Let's visualize what this means with a price chart. As you can see, raw price data often contains significant noise and fluctuations, making it difficult to identify the underlying trend. A moving average is calculated by taking the average of a stock's price over a specific number of time periods. This creates a smoother line that filters out short-term fluctuations and helps traders identify the underlying trend direction. Moving averages offer several important benefits for technical analysis. The moving part of moving average refers to how the calculation window shifts forward with each new price period. Moving averages are one of the most widely used indicators in technical analysis because they're simple to understand, yet powerful for spotting trend directions and potential reversals. There are several types of moving averages used in technical analysis. To understand how each type works, let's look at a sample price chart. The simple moving average, or SMA, gives equal weight to all price points in the calculation period. It's easy to understand but less responsive to recent price changes, making it better for identifying long-term trends. The exponential moving average, or EMA, places more emphasis on recent prices. This makes it respond more quickly to price changes and reduces lag compared to the SMA, making it effective for capturing medium-term trends. The weighted moving average, or WMA, assigns different weights to data points, typically giving more importance to recent data. It's more responsive than the SMA, but less than the EMA, providing a good balance of responsiveness and stability. The Hull moving average, or HMA, reduces lag while maintaining smoothness. It's created by combining weighted moving averages and is the most responsive to recent price changes, making it excellent for short-term trends and generating trading signals. Notice how each type of moving average responds differently to price changes. The Hull moving average reacts most quickly, followed by the exponential moving average, then the weighted moving average, and finally the simple moving average. Each type of moving average has specific advantages depending on your trading strategy and time frame. Understanding these differences will help you select the most appropriate moving average for your analysis. The exponential moving average gives more weight to recent prices, making it more responsive to new information. The EMA calculation involves a weighting multiplier that applies more importance to recent data. The formula is EMA equals close price minus previous EMA multiplied by 2 divided by n plus 1 plus previous EMA, where n is the number of periods. The key to the EMA is the weighting multiplier, which determines how much importance is given to recent prices. This multiplier, alpha, equals 2 divided by n plus 1. For example, a 10-period EMA has a multiplier of 0.182, while a 200-period EMA has a much smaller multiplier of 0.01. The smaller the period, the more weight given to recent prices. Let's see how the EMA responds to price changes compared to the SMA. Here we have a price chart with a sudden increase, followed by a gradual decline. Notice how the EMA reacts more quickly to the price change than the SMA. This makes the EMA react more quickly to price changes than the SMA, which can be advantageous in fast-moving markets. Let's walk through a practical example of calculating a 5-day EMA. First, we calculate the initial EMA value, which is typically the same as the first SMA. Then we apply the EMA formula for each subsequent day. To summarize, the EMA offers several advantages. It responds more quickly to price changes, reduces lag in trending markets, and can be more effective for shorter-term trading strategies or in fast-moving markets. Traders typically use specific time periods for moving averages based on their trading strategy and time horizon. Short-term traders often use 5, 10, or 20-day moving averages to capture quick market movements. These shorter periods respond rapidly to price changes, making them ideal for day traders and swing traders looking to identify entry and exit points. Medium-term traders typically prefer the 50-day moving average. This period strikes a balance between responsiveness and noise reduction, making it useful for position traders who hold positions for weeks to months. The 50-day moving average is widely followed by market participants and often serves as a significant technical level. Long-term investors commonly use the 100-day and 200-day moving averages to identify major trend changes. These longer periods smooth out short-term market fluctuations and noise, providing a clearer picture of the underlying trend direction. The 200-day moving average is particularly significant as it's widely watched by institutional investors and often acts as a key support or resistance level. Many consider the position of price relative to the 200-day moving average as an indicator of bull or bear markets. When price bounces off the 200-day moving average, it can confirm its role as support in uptrends or resistance in downtrends. Crossing above or below this level is often seen as a significant technical event, signaling a potential major trend change. Moving average crossovers are one of the most popular trading signals used by technical analysts to identify potential trend changes. Let's visualize how these crossovers appear on a price chart and what they signal to traders. Here we have a price chart showing a typical market cycle. Now let's add two moving averages, a 20-day MA in green representing the short-term trend, and a 50-day MA in gray showing the longer-term trend. When the shorter-term moving average crosses above the longer-term moving average, it forms what's called a golden cross, signaling a potential bullish trend. Conversely, when the shorter-term moving average crosses below the longer-term moving average, it forms a death cross, indicating a possible bearish trend. Now let's look at common moving average combinations used by traders. The most widely followed combination is the 50-day and 200-day moving averages, which is used to identify long-term trend changes in markets and individual stocks. For short-term traders, the 5-day and 20-day moving averages provide more frequent signals, suitable for capturing shorter market movements. Remember that while moving average crossovers can provide valuable signals, they work best when combined with other technical indicators and proper risk management. Next, we'll explore how moving averages can act as support and resistance levels. Moving averages often act as dynamic support and resistance levels for stock prices. During an uptrend, when a stock price pulls back, it often finds support at its moving average level before continuing higher. Notice how the price repeatedly tests the moving average and then bounces higher, showing the moving average acting as a support level. In a downtrend scenario, the moving average typically acts as resistance. When prices bounce upward toward the moving average, they often fail at this level before continuing lower. Here we can see how the price repeatedly tests the moving average from below and then falls, showing the moving average acting as resistance that prevents further upward movement. The 50-day and 200-day moving averages are particularly important support and resistance levels that many traders and institutional investors watch closely. Let's look at how these important moving averages interact with price action over time. Here we can see several examples where price finds support at the 50-day moving average shown in green and the 200-day moving average shown in gold. We also see instances where the 50-day moving average acts as resistance during price declines. These moving average levels are significant because they're watched by major institutional investors who make large trading decisions based on them. The 200-day moving average is often considered the dividing line between bull and bear markets, while the 50-day moving average signals medium-term trend changes. When price breaks through these moving average levels with significant volume, it often signals an important change in the trend direction. While moving averages are useful technical indicators, traders should be aware of their limitations. There are 5 key limitations to consider when using moving averages in your trading strategy. First, moving averages are lagging indicators based on past prices, making them slow to respond to rapid market changes. Second, moving averages work best in trending markets, but can generate frequent false signals in sideways or choppy markets. Third, different types of moving averages and time periods often produce conflicting signals, leaving traders uncertain which one to follow. Fourth, moving averages don't account for fundamental factors affecting stock prices, such as earnings announcements, economic data, or industry developments. Finally, because of these limitations, moving averages should be used in conjunction with other technical and fundamental analysis tools to confirm signals and provide a more complete market picture. Being aware of these limitations helps traders use moving averages more effectively as part of a comprehensive trading strategy. Let's explore practical trading strategies using moving averages. Moving averages can be applied in several ways to create effective trading systems. Longer-term moving averages help identify the market's overall trend. A common approach is to use the 50-day and 200-day moving averages. When price is above both moving averages and they're sloping upward, this confirms an uptrend. These simple rules can help determine whether to look for buying or selling opportunities. Moving averages provide clear entry and exit signals for trades. Two popular strategies include crossovers and bounces off moving averages. When a faster moving average crosses above a slower one, it generates a buy signal. When it crosses below, it creates a sell signal. Moving averages also act as dynamic support and resistance levels, where price often bounces. Traders often analyze multiple timeframes to confirm signals and improve accuracy. A common approach is to use the higher time frame to determine overall trend direction, the middle time frame for entry timing, and the lower time frame for precise entry points. Effective risk management is crucial when trading with moving averages. Always use stop losses when trading with moving average strategies. Common practice is to place stops below significant moving averages, risk only 1 to 2% per trade, and use trailing stops as trades move in your favor. Many traders combine moving averages with other indicators like RSI or volume for signal confirmation. For example, a moving average crossover combined with RSI confirmation can reduce false signals. Remember that no strategy works in all market conditions. You must adapt your approach based on whether the market is trending or ranging. To summarize, effective moving average trading strategies require proper trend identification, clear entry and exit signals, multiple timeframe analysis, and strong risk management. By combining these elements and adapting to market conditions, you can develop robust trading systems using moving averages.